The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello and welcome to this Become a Pro course here, presented to you by Forex.Academy. I am your host, Robert Blackwell. I have the pleasure today to walk you through the final lesson of the Become a Pro course. I hope we've all enjoyed it at this stage. We've taken in quite a lot of context in terms of how to fundamentally analyze the markets, how to use technical analysis. It has been quite heavy at stages, but remind you as well, you do have all of this for revision purposes within your members login area. So I do advise you to go through and really get to grips, really further understand everything we've went through throughout this Become a Pro course. We're starting to build it all together now, guys, and the last webinar today will discuss developing a profitable trading strategy. So it will be a very complex, very enjoyable lesson. And again, I do encourage everyone to shout out, ask some questions as we go through today's education. Of course, there is risk inherent in trading the financial markets, so please consult the following disclaimer and take on board the risks involved. And just a few pieces of housekeeping before we begin each live interactive webinar. Make use of the interactivity with live webinars, guys. Feel free to ask questions throughout. If you just click the right hand side of your screen there, you have a question and answer section. You can actually just open that there and ask questions throughout. I'll be able to see them on screen here and correspond with you as we go through the webinar. The live webinar is being recorded and will be placed into your members login area once we have concluded it. Again, for revision purposes for the entire Become a Pro course, it's there for our members to go through as much as often to really garner and gather as much information both on the fundamental, technical and sentimental side. And obviously today we'll be discussing trading strategies, so very, very important indeed. Of course, guys, of course, I'd like to open up the floor to questions at the end of each webinar. And today I'll do the same, of course. Today I'll have an extended Q&A if you'd like to go through many topical issues throughout the course as well. So if you'd like to hold off until question time at the end, we can certainly do that as well. Just to recap again, with this week, we've looked at market correlations, risk and risk aversion, portfolio diversification. So we discussed how to look at spreading risk across asset classes, how to look at short, medium, long-term trading positions. And now we are going on to the final Become a Pro lesson, developing a profitable trading strategy, okay? We aim to build a structured trading strategy in line with trader expectation and risk management. And the key there that I would point out, guys, is in line with trader expectation. Everyone is different, and that's what we're going to discuss throughout our webinar today, how to define and realign your trading expectations with the type of trader and the type of style that you'd like to commit to. So in developing our trading strategy, let's discuss evidently how to look to focus towards profitable trading. Professional traders are experienced and use all the information and skills available to them to trade the financial markets, okay? Individual trades may, of course, take on a wholesome technical objective, but this is not a result of ignorance or disillusion, guys. Even when the best technical opportunities present themselves, we choose never to ignore market moving fundamentals, okay? And that is the point of gathering more experience and becoming much more experienced about trading in financial markets, guys. The fact that you'll have some know-how, you can actually use this to better trade the markets, of course. Now, for those guys who are questioning, well, perhaps I've learned a lot here, but I do want to become a technical trader and trade all these asset classes that I don't know a lot about fundamentally. That is the case. That's absolutely fine. That's not what we're saying. We are saying, for example, you do not ignore fundamentals that are there. For example, let's say we have the Brexit decision, or we have a political conflict across the Middle East, or an election here in Ireland or the UK or in Europe. Of course, you're not looking to technically trade 4 to 5 open positions the day before an election, so you choose not to ignore market moving fundamentals. Okay, so that is focused in on trading strategy, of course. Developing a profitable strategy is as much about what works for you as an individual trader in relation to your appetite for risk, your knowledge of the markets you trade, your account size, and your level of activity. Okay, so whether you want to be a short-term scalper and place 10, 15 trades a day, or whether perhaps you would like to place 10 trades a month, perhaps on a more quantitative account size, and you're looking for long-term opportunities. It is down to you, of course. So it's a quest, I suppose, developing a trading strategy to answer the question, I suppose, what works best for you, what suits your trading style, your level of risk. Do you only want to trade 3 or 4 markets that you are very, very familiar with, perhaps some equity indices? That might be the case. Okay, so you can look to really capitalize on your skills. So let's move forward to actually discuss then what we're all familiar with here, guys. And the question is always, and it's going to be in terms of developing profitable trading strategy, the question is always going to be, how can I profit? So what we have on screen, guys, is the cable market and the FTSE 100. Now, fundamental analysis is not as simple as deciding if an asset is over or undervalued like we talk about equity trading. It is about knowing which markets are affected by news and economic events and trading that opportunity. Okay, trying to realize that opportunity. So here we have an opportunity, no interest rate increase in the UK amid large scale US dollar appreciation. So how can I profit with this? So there are many different trading strategies we can use, guys, and this is all stuff that we've learned and that we're all hopefully thinking about culminating together to develop our trading skills as a trader. Now, the reason I have the large chart here in front is because you could home in on this evidential opportunity in the short term. So what we could look at really is some price action to tell us, well, the market has perhaps broken some sort of level here. We can see on the long-term chart we have this level here. And effectively, if that level is something like this, when am I looking for a signal, a candle to perhaps get in? And this is our signal here, just with this rejection candle, okay? It tries to trade up. It is inevitably a bearish hanging man candle. And then we get the move to the downside. So that is telling us that this is an explosive move and is more likely or more probable to trade to the downside. Okay, so we're trying to understand the fundamental story behind the news flow. And we're really technically trading the market. So we're trying to combine both. Can we see that? So again, what I'll just do, that's now more reservedly discussing simple price action. But again, that might be because you want to trade this for 3 days and you want to sell at these prices here and take profit at these prices there. That's a fantastic trade. That is your own trading strategy for your own style. People are different, of course. So you might look at this as a more fundamental move and say, well, if I can get the technical setup, and again, you could use much more technical analysis, but here I have the long-term trend line, okay, the long-term price channel with the trend line as well, okay. Inevitably, this is the point where the market breaks. You can look for the signal with the candle to take the trade, of course, and then you're holding this position for a long-term carry trade in the cable market to the downside, of course. So how can you profit? Well, there are 2 separate trades that we've discussed, one in the short term here and here perhaps, and perhaps you like the long-term trade. You're going to jump in and out of these markets depending on your trading style, which does not conflict with strategy. And of course, now that we're considering a long-term depreciating in sterling, we know what happened with Brexit when sterling decreased 10% overnight. Basically, there was a large bolstering effect for all those FTSE companies that do most of their business in US dollars abroad. Then when they changed that profit or revenue back into sterling, the fact that sterling is depreciating, of course, it's much more capital for them. So effectively that reprices the FTSE 100. And the trade again is, how can I profit? Well, I know that there's a fundamental situation. I know that this is the case study here, and I know that there are different opportunities. So it's much more about simply looking at a market to say fundamental. I'm a fundamental trader. I think it's undervalued or overvalued. No, we use our ideas, our trading strategies to look for economic events and trade or realize that opportunity. So again, with the FTSE market, we could look to sell sterling. We could look to scalp in around the Japanese candlesticks here. We could look to buy the FTSE, given the long-term appreciating factor that sterling decline has on the FTSE. So there's many different trades that you can get across. And again, I have this tagged under fundamental analysis as an opportunity, but you can see we're starting to develop skills, guys, all of us throughout the Become a Pro course, starting to devise these skills to analyze the markets, not on a one-dimensional basis. We are effectively developing our hybrid approach to trading, and the more skills we can use, the more know-how in the markets, the more of a competitive edge we're going to develop, certainly trading many different assets. Okay. Again, I have this under fundamental analysis, but you could trade this in many different ways. But let's just discuss now, what do we have on screen first of all? What do we have on screen? Well, we have the S&P 500, okay, which is the largest equity index there in the United States by market capitalization, consisting of 500 large weighted cap companies. Then we have the Nasdaq 100, the tech-heavy 100 companies, okay. Then Amazon, and then another single stock, IBM. Okay, now we can see quite a convergence, divergence, excuse me, with price action from Amazon and IBM, albeit they're both in the Nasdaq. Okay, so we can simply just start to price things in and start to ask questions when we see things like this, and we look for opportunity. We assess the US equity environment. We assess the current risk theme in one single equity index. You know, is the Nasdaq still outperforming all other indexes? If that's the case, surely it's the one to buy, if that's our directional bias. Assessing the current volatility of stocks within the index. Okay, so perhaps the volatility is much more that of IBM or the semiconductor sector than Amazon, a more observed technology retail company. Okay, so we assess the current volatility of stocks within the index, and we seek the best opportunities. And again, simply how can I profit? How can I look to profit in these trades? If I believe that perhaps the Nasdaq is going to be very strong over the, very strong over the short to medium term, is there a trade I can perhaps get off here? Well, of course I can hedge in the Nasdaq. So let's say I buy the Nasdaq here at these prices, and then I decide that Amazon is outperforming, so I'm going to buy Amazon here. So we've got two buys here, and again we can position with our trade size to accompany some risk, and we're going to hedge these two buys with a short in IBM. Why? Because IBM is weaker. It's in the Nasdaq, of course, but it's weaker. So if these markets all rise, we'll take a short trade here in IBM. Effectively, guys, what may happen is, well, let's go through in some detail. We see these prices rise up here in the Nasdaq 100. We see Amazon rise again, and effectively what could happen is, well, Amazon or IBM will rise, of course, most likely as well, but at a slower rate. And we effectively, given that it's weaker, will take a loser on this trade because we're short this market. Okay, so effectively that is going to be our losing trade, whilst we gain some very good winners in our hedge trades as well. Fundamental analysis, we're using price action, we're using trend lines, we're using some technicalities in there just to start to stimulate ideas about trading these markets. Okay, and that is effectively all these different trading strategies in terms of how we enter and exit the markets become much more clear to us now, in terms of there's many different ways to effectively get involved in making money in these markets. We did go through market correlations there on Monday and discussed spread trading as well. This would be one example where we can effectively gain some exposure there in the Nasdaq whilst hedging ourselves. So let's have a look then at some perhaps technical analysis. Again, we're just starting to stimulate some trading ideas with strategy. You may not want to consider at all why gold is moving, but simply involve yourself in the opportunity. Okay, so this is really the theme, I suppose, of technical analysis. We accept efficient market hypothesis. We accept that all news is available and fully reflected or embodied in the price as it moves. So we simply want to trade that price technically. Now that's absolutely fine. So we simply only want to trade the gold itself with the price, or you may not want to trade the fundamental factors pricing gold, which is fine at the moment, and use technical analysis to look for points of interest. Okay, so that's effectively what we're doing. And we have a Fibonacci retracement here, just from swing high, long-term swing low, to swing high, And again, we can see that there are trades to get off here if you're positioning in the markets in around these times. We can see this level again has held up quite significantly, albeit it hasn't breached our level here, so it still has held up. So it's effectively providing a level of support there at our 38.2% retracement. And again, when the market breaks to the downside, it stops at our 61.8% retracement. And there's many different ways we could have traded that. Again, if we were short the market here, let's say we short the market around these prices, or as it pops up here, we short it here, anywhere at all, we get the big move. Now that we see this candle to the downside and these further candles, well, we know it's right, stopping right at a 61.8% retracement. We can exit for a trade, or if we're not in the trade, we could look to buy the market at this price. So again, many different ways, just purely on the technical side. Again, if we're a fundamental trader, guys, and we want to say, well, the US dollar is very, very strong at the moment, I'm waiting until the technical trade breaks through. You're effectively looking to trade a fundamental story there that the US dollar is strong and gold should trade strongly to the downside. However, of course, there are other factors pricing gold, inflation being one of them, and the Fed has made some comments on that recently. However, what can help you make that decision is the technical analysis here with your Fibonacci. Don't forget we have a volume parameter here as well, so if we get a break of this level and a close below our 61% 8 level, the Fibonacci signal is invalid and it's not a retracement, it's a reversal. And if we get a volume figure, let me just move out. If we get a volume figure, the next big candle showing us something like this, and the market closes here, that is significant for me to say, well, there's a lot of volume increase in this market. We've broken a key technical level. I thought, or I think fundamentally, that the dollar is so strong at the moment that this has to break and go to the downside quite strongly. That is the trade I'm taking. So you're starting to formulate ideas, you're starting to formulate trading strategies with the skills that you have and the education that you've taken on board as a trader. And again, how can I profit? We've went through a technical setup there. Sentimental analysis, again, just quite simple that we can touch upon, guys. Buyers and sellers, what is the fractional cost, or what is the percentage of buyers as adverse to sellers looking to trade the market? And again, we can simply look at the trend here and you try and answer the question, where is the momentum, direction and trend? How can I profit in this market? So this is very basic stuff, again, sentimental analysis, but it always factors into your trading. When you look at the trend, you look at the momentum. Perhaps in the last example, I used volume there to see, well, that can give me a signal to the momentum is moving to the downside, and that's confirmed by the volume. Now I want to use a sentiment shift here with this US dollar strength to trade gold, or what we have here is US oil, WTI oil, of course, on screen. This market is trading to the downside in the short term, and again, we know that it is particularly strong over the long term, but if we see a trend develop in the short term, perhaps we can look for those opportunities simply by asking the question, well, where is the short-term momentum and the direction in this market? Where is it moving to in the short term? Okay, so many different ideas we can implement across these markets. In terms of developing our trading strategy, we're starting to pull things in together, fundamental, technical, and sentimental analysis again. And the point I would like to make, guys, is deciding on applying fundamental, technical, and sentimental analysis for a particular decision absolutely does not contradict a rules-based technical approach, or vice versa. It does not contradict the fact of a fundamental trader who trades completely on all fundamentals. One example of this is the oil market there. It traded and flirted around $50 to $55 for such a long time. The gold market as well at 1303 is a very significant technical level that even if you're a fundamental trader, you're aware of that level, and when it breaks, you can get confirmation on a trade. So it does not contradict one or the other. You are fully able to complement these skills into a hybrid trading approach. Remember, trading is about how much profit you can make in the markets on a consistent basis, not about finding the holy grail of technical indicators, for example. Okay, and that's certainly the case as we walk through a lot of technical indications throughout this course. There is no one technical indicator that works best, or one that work 70 or 80% of the time. You use technical confluence, which we discussed, to combine all of these indicators, use your knowledge of the market, really get involved in trading these markets, and that is your trading edge. If you can use a plethora of skills and information to outperform the markets, then certainly put them to use. And that is the point we want to make there, guys. That is the point in all of you guys joining the Become a Pro course and really gearing up to gain a strong level of experience trading different asset classes, looking at correlations, looking at risk management, looking at the technical indicators. All of this stuff together is going to make you a much better trader. If you have developed a very technical strategy that does not make profit, it is worthless. Okay, and I just want to make that point, guys. I'm just being quite frank. Sometimes when I approach trading, I like to be quite honest about it. And there's no point in pulling the wool over anyone's eyes. If you have a very well developed technical trading strategy and you've been working on it for 6 months perhaps, and you've tested it and back tested it, and it's actually not profitable at all, well, guys, it's not very valuable at all. If you're overtrading and are not seeing results, cut back on trade count and focus on quality over quantity. So if you're developing a trading strategy and it's based on scalping, a certain period of time, and you're choosing different markets, but you really feel that you're pushing it, you're overtrading, well, guys, you have your answer there, and that's often the result for some traders that pulls them back. You often see many traders, who are good traders and have very obvious I suppose neglecting skills in terms of how they approach the markets. Many traders actually use technical analysis very well and have a strong fundamental knowledge about the markets they trade, but cannot profit. Okay, can't profit over the long run. This is because a well-developed trading strategy is not only about application, but revision. And what do I mean when I say revision? Well, monitoring and revision allows adaptation, profit taking, and loss reduction. Okay, so this is so key. This is so crucial, guys. This is why we look to mitigate risk across markets. This is why you look to take profit sometimes when you just decide it's the right time. Let me give you an example. Let's say we make a trade in the oil market, you have a profit objective of $3 to $4, but there's a shock to the market and it jumps at $2 in one day. And then the next few days it just trades flat lines, it just trades sideways. Well, the market's giving you $2 in a short space of time, and then it's doing nothing. Do you really want to stay in that trade for another long period? It might consolidate there for another buck on the dollar, or another 50 pips. Not the case. So, you're going to be paying attention to that market. You're going to be focused on it. It's going to merit some concentration. Where you could take profit, $2 is a great winner in the market, 200 pips, say, for example. Then you can look across other markets to say, well, I've made a great trade there. I can focus my attention elsewhere. So we have time for revision. Monitoring and revision allows adaptation, so we can adapt to current conditions as and when they change. Profit taking and loss reduction. The key to developing a trading strategy is to align its application with profit performance. Okay, profit performance. Now, what do I mean by profit performance? Well, profit targeting, guys. Now, this isn't to say that you simply look to, discuss a risk-reward ratio that you think suits you. No, it means that you need to be able to say, well, how can I apply a trading strategy that I can definitively call it a profitable trading strategy? Well, the answer is you can't. You can't unless it shows you a consistent value of profit. And the way to do that, the way to assess that and assess performance is to enable or apply some profit targeting mechanism to your trading strategy. That is the secret to overall consistency, guys. Okay, so we're going to go through some of these issues in a lot of detail. If we were to devise a strategy, a trading strategy based on a successful hit rate or a high hit rate, this is the percentage ratio of winning trades versus losing trades, we would not properly be able to quantify how much money we expect to make with our own trading strategy. Okay, and too many people actually focus on this. They want to, if they take 2 or 3 or 4 losers in a row, they're worried about the hit rate, that they've had, maybe 10 trades during the course of the day and 7 of those trades were losers. Now, that's of course not advised, but it shouldn't play a factor in your trading. Hit rate is not what it's important. And this is because we look to engineer our own profits, guys. So we need to start to, understand hit rate can help you, but it's not a primary function of successful trading. As financial traders, total success is based on the amount of money we make from trading the markets. As such, we simply have no choice to develop a trading strategy around profit targets. I hope that makes sense. So let's go through it in some detail. Here is your hit ratio. Okay, we have a total of, let me see, we have 30 trades on the board here. Winning trades, 19 trades. Losing trades, 11 trades. Okay. Hit rate is 63%, so that's very, very good, but it doesn't tell us much, does it? Does it tell us, is this a successful trading strategy? Is this a consistent trading strategy? Or is this actually profitable? How much money have I made over 30 trades? The answer is we don't know unless we are able to delve deeper into this particular trader's trading week, or to effectively look through the different assets to count, to accumulate his wealth. It might change from one week to the next. There's no idea in terms of his hit ratio. Has he just been trading very well this week? How do we analyze their performance? Of course, it's very difficult to define that as a strategy itself, never mind its consistency. So what we want to focus on is profit targeting, not hit ratio. Now, there are several ways to do this. Although improving on your percentage hit rate will help to improve your overall financial performance, and that is the case. That is the case, and that's why there's often some confusion there. People who do trade, let's say they're delivering 60% winners, 40% losers, they are of course more likely to be successful traders. However, guys, that may not be the case. And for many of us who've been trading in the markets for a long time and banging our heads, I suppose, off the table sometimes to develop our consistency and our profitability, that may be one reason. You may be asking yourself, why are you not so profitable? You're delivering a 60-40% hit ratio. Well, that's the reason. You've been focusing too much on hit ratio. It can benefit your trading, but it's not beneficial to form the basis of your trading strategy. In order to develop a profitable trading strategy, we simply must choose to base performance review on profit targeting and have several different options to choose from. What are these options, you may ask? Monetary value is one, total pip gain is another, and account percentage trading is yet another. Okay, so this is effectively how professionals develop their own professional trading strategy. It's not just, developing your trading strategy is not, well, how do you trade the markets? Well, I'm just a technical analyst. I get involved, I read the indicators well. Well, that's all good. That's telling me nothing really. It's telling me how you like to enter and exit the markets. It doesn't tell me how you assess your profitability, how you define your trading strategy as profitable. Does that make sense, guys? Can I get a show of hands, just yeses or nos? Does that make sense? Yeah, I get plenty of yeses in here. Great. Yeah, fantastic, great. Unanimous amount of yeses in there. So it's not just about how to enter and exit the market, and that's not the point of this lesson as well. We did a lot of technical confluence there in technical analysis 1 and technical analysis 2. We did a whole lesson on price action specialist trading, how to enter and exit with the candlesticks and how to move around. That's great. That helps us. That's effectively how to develop your trading strategy, of course, in terms of entry and exit. But how do you monetize that? How do you turn your ideas about entering and exit into a profitable trading strategy? It has to be one of the three here, guys. It has to be one of the three, and there are serious advantages and some disadvantages to them all. So we'll discuss monetary value first of all. Defining a trading strategy based purely on monetary value has many advantages to professional trading. It is objective, okay, completely objective with its regard to fulfilling its goals, and should be resolute in determining an expected level of performance. Okay, so resolute and objective, okay, and objectivity is one of the main goals of a professional trader. You place a trade, it's going to be a loser or a winner. You'll be objective, okay, you're not under any pressure, you move on. That is effective trading. Its method must dictate a balance between monetary reward and monetary exposure. Now that sounds similar to me as risk reward ratios, and that is the case, of course, but it's more fractional than that. Of course, you'll need to implement it in your own style. But it is going to be a balance between your monetary reward and monetary exposure. So how much are you looking to expose in the trade? What is the reward you're looking to gain? You will always have an expectation on how much you wish to gain on a particular trade, and you'll always know how much you're willing to trade on lose on a particular trade. So that's fantastic. Now, some traders using monetary volume, and we'll look at some trading accounts now, will actually know exactly how much they're going to gain, because they place profit targets on each particular trade. Other traders do not and let the market dictate, but they know, all traders should always know how much you're willing to risk or lose on a particular trade. So we've seen quite a few trading strategies and quite a few trading accounts there yesterday with the previous lesson on portfolio diversification, but that was much more focused on asset allocation. Here we have much more detail in terms of different trading strategies. The question is totally hypothetical, guys. I would just like to point that out. Okay, so which is the most consistent trading strategy? Okay, so let's have a look across our data here. Trader 1, 2, 3, and 4. What do we think, guys? Which is the most consistent trading strategy? Now, we don't know how they enter or exit their trades, whether they're fundamental or technical traders, whether they are a hybrid, or whether they're simply scalping the markets, of course. And we have 4 different traders, perhaps they use different strategies. But in terms of consistency and starting to get, generate our ideas about profit targeting, which seems to be the most consistent strategy? So let's go through them in detail. What I'll use is my yellow pen here. Trader 1 again. So we see he has, of course, different assets across the board. That's fantastic. And again, he's getting in. Now he has chose to allow a monetary exposure of 10 euros for each particular trade. So that's functionable. Now we're not aware of the size of these traders, these 4 traders' account, but he's chosen to quantify his amount by 10. Okay, his risk per trade by 10. And you can see, guys, that effectively he has fantastic risk management. That's the first thing now, because he hasn't actually taken one full 10 euro loser. He's cutting all those losers short. So here's one here, here's another, and yet another, just ready to take it, yet another, so happy to take some of those losers. So that is a key lesson, of course, and this is what I'm referring to when we discuss revisability, guys. We're able to revise the trade. It's such a skill, guys, and I advise anyone to do this. If you place a trade, right, and you look to buy an equity market and the market starts to move up, drift up during the course of the day, and let's say it's a European equity market, okay, and you're 40 pips on side and you're very happy, but you're looking for 100 pips, okay, then it comes to 2:30 UK time, 3:30 European Standard Time. That is the open of the US cash markets, and a lot of volume will come into the markets then. And you see the US markets, the Nasdaq, the Dow Jones, the S&P start to tank. They start to trade. Maybe some news comes out. What should you do? What could you do? Well, of course, many things. You could look to move your stop loss to break even to mitigate risk to 0, or I could look to simply take profit. Now, Trader 1 here has effectively done that across the board. He has never taken a full 10 euro loser. He's taken a 9 euro loser because he knows, well, with his, it depends on the trade, he's happy to take that loser. It's very likely to happen. And he's taken a 4 euro loser because he might have just got into the trade, it started moving heavily against him, and he's just got out for a smaller loser. So very effective trading strategy. Trader 2 again with his monetary exposure at 20. You can see he has done some great trading. What we can point out again is some red flags. His monetary exposure has been 20 euro, but he's effectively broken it on several occasions. So this is over the course of 15 trades. I would suggest that this trading strategy isn't a resolute trading strategy. Perhaps he's moving stop losses. He's not sticking to his trading strategy. So Trader 2 definitely does not get my vote. Okay, Trader 3 again. So we have 10 euros again for monetary exposure. Let's go through some of his trades. Again, what we can see, some great trades there. Again, cutting losers short, that's fantastic. But again, a big no-no. We've taken a 20 euro loser, twice the loser on the size of the trade. and another one is just over the mark again. So effectively, he's broken his rules, I suppose, in terms of his monetary exposure. Now, Trader 4 has adapted something quite unique here, quite unique indeed, and I would argue that this is perhaps the most consistent trading strategy. Well, why? Not because of the overall value. Effectively, Trader 1 has outperformed all of the other traders. However, just have a look at how he's trading. His monetary exposure is 15 euros to the downside in each individual trade, and look at his profit and loss. He's effectively running a 2-to-1 risk reward trade, okay? Risk reward ratio on his trading. However, he's outperforming. So if he's looking for a 15 or he's willing to accept 15 euros risk per trade, and his 2-to-1s pay off sometimes, you can see he's very successful at his trade options here. Effectively, he's probably trading with the momentum in the short term, getting in and out, but not reacting. He's simply letting the markets trade to him given his analysis. So he is effectively running a risk reward. You can see all his winners are 30 euros, which is great. And again, all his losers are within the remit of 15 euros. So that is, I would argue, the most consistent trading strategy, and it's in its implementation, which is very, very unique. Now, the reason I chose to, I suppose, choose Trader 4 as the most consistent trader is because, guys, we can use this as consistency. We can use to gauge this as a level of performance, so that in some time we can date it, and in some time we can call this a developed profitable trading strategy. So let's look across this strategy, okay? Well, we have 15 different trades here over the course of perhaps a week or a day. We're not sure. Of course, many different assets are available. He's traded a lot of Forex pairs. He's traded some Bitcoin, SMA 20, the Swiss market index. We've traded cocoa as well. So some great exposure across different markets, okay? So let's have a look at assessing what this is telling us, of course, across his trading exposure. Well, let's take for example that risk is constant. Now, what I mean is risk is constant. He has, of course, placed a stop loss of 15 euros for each individual trade, so that's constant. However, let's assume, even for purposes of discussion with all of the traders, that they have not opened all 15 trades at the one time and aren't open to total exposure on account. Okay, so let's go through his profit here in terms of trading. Well, first trade's a winner, okay, and we'll just go through this in terms of his consistency. You can see as he gears up, he takes winner, loser, continue to take losers, and part of the game. And his last trade's a winner, okay? So very consistent, and what it actually develops is a profitable profit trajectory, okay? A profitable profit trajectory. So that is effectively what you're looking to develop as a trader. Now, this is just one example over 15 trades, and it's just really to show you, what you want to look for over your portfolio or your trading account. What you can do, guys, is apply this to perhaps a quarter. Over the quarter, if you make perhaps 400 or 500 trades over the quarter, try and quantify them. Try and quantify them and put them into a signal table like this to give you a profit trajectory to see how successful your strategy is, just to see how you're getting involved in the markets, see how it's working, guys. And it might result in totally technical. If it's totally technical off 3 or 4 indicators, and you do this over 400 trades over a quarter, and you get a similar profitable profit trajectory, well, guys, you've made it. To be quite honest, you're successful traders. That's something you can rely on, your own skill set, and you will be able to trade the markets for the end of your days. So that is exactly what you want, and that's how we approach these markets in terms of consistency. And once you get it right from the start, guys, you'll be delighted with yourself, because you'll be able to rely on that source of income as secondary income, or however you want to approach the markets, for such a long period of time as well. So focus in on this profitable profit trajectory, see how the performance goes for you, and try and make your risk constant in a way that is structured towards developing a profitable trading strategy, okay?